Hello, and welcome to Principles of Macroeconomics, Module 3.1. Today we're going to start our discussion of the aggregate demand and aggregate supply model. Specifically, we're going to focus our discussion in this module on aggregate demand. Now, the aggregate demand, aggregate supply model allows us to understand why an economy has growth in the long run and why it responds to short-run fluctuations. We're going to be able to use this model to understand how price levels change, as well as how output changes in response to short-run shocks. So again, our focus today in this segment is going to be on aggregate demand. And aggregate demand is going to reflect the demand for all goods and services in our entire economy that are demanded by households, firms, and the government. So when we look at aggregate demand, the components of aggregate demand are going to look very similar, actually identical, to our definition of GDP. If you recall, our output, or GDP, is going to be equal to consumption spending, C, investment spending, I, government spending, G, and net exports, NX. So our aggregate demand is going to be comprised of each of the components of GDP. We'll see that aggregate demand is going to be a downward sloping line with the price level on the y-axis and real GDP, or output, on the x-axis. So why do we have a downward sloping aggregate demand curve? Well, there are three effects that occur that create a response by one of the components of GDP, one of the components of aggregate demand, that tell us how aggregate demand responds to different price levels. The first is what we call the wealth effect. At lower price levels, the value of money is high, and this tells us that people are going to feel wealthier at lower price levels, meaning that they can buy more with the same dollar. So at low price levels, we expect that consumption spending will be high. The opposite will be true at high price levels. At high price levels, the value of money is going to be low, and people are going to be able to buy less with each dollar in their pocket. As a result, they're going to feel less wealthy. So at high price levels, consumption spending is going to be low. If consumption spending is going to be low, all else equal, aggregate demand will also be low. The next effect is the interest rate effect. At low price levels, households are going to reduce their money holdings by lending some of that money out and trying to gain interest income. As a result, this will cause interest rates to fall, and firms are going to be encouraged to borrow more. As a result, what we see is that at lower price levels, investment spending is going to be higher. If investment spending is going to be higher, all else equal, aggregate demand will be higher. The opposite is true at high price levels. At high price levels, people need to hold more of their wealth in liquid form. And therefore, there will be less money in interest-bearing assets, less money available for firms to borrow for their investment spending, and therefore we will have lower investment spending. So that at high price levels, investment spending is low, and as a result, aggregate demand is low. The last effect is the exchange rate effect. And this effect mirrors what we just talked about with the interest rate effect. Essentially, what it tells us is that at lower price levels, if we expect that interest rates will also be lower, this is going to tell us that domestic and foreign investors are going to want to seek higher returns abroad, and therefore they're going to move their wealth to higher returns in interest-bearing assets in other countries. As this happens, this causes a capital outflow, and the demand for the domestic currency diminishes. This causes a depreciation in the domestic currency. When we have a depreciation in the domestic currency, this is going to cause exports to be less expensive for foreign buyers and imports to be more expensive for domestic buyers. Therefore, exports will rise, imports will fall, and as a result, net exports will rise. So that at lower prices, we expect higher net exports and, all else equal, higher aggregate demand. The opposite will be true at high price levels. At high price levels, we expect interest rates to be higher and an inflow of capital from foreign investors. pushing up the value of the domestic currency, causing exports to be more expensive and imports to be cheaper, causing net exports to be lower. So therefore, at a high price level, all else equal, net exports will be lower, and therefore aggregate demand will also be lower. So these three effects explain why we see a downward sloping aggregate demand curve. Now, why do we have and how do we have changes in aggregate demand? Well, remember, we were saying that the components of aggregate demand are directly linked to the components of GDP: consumption spending, investment spending, government spending, and net exports. So therefore, if we see a change in consumption spending, or a change in investment spending, or a change in government spending, or a change in net exports, we will also see a change in aggregate demand at each price point. So if we see a change in any one of those components, we can anticipate a shift in aggregate demand. So what have we learned in this segment? Well, the aggregate demand and aggregate supply model is a critical model for us to use to analyze what is happening in the aggregate economy. The aggregate demand curve is one part of this model, and it helps explain the spending behavior and the demand for goods and services by buyers, households, firms, governments, and foreign entities. We will continue on with our discussion of the aggregate supply curve next, and then bring everything together to understand the AD and AS model. Thank you so much for joining me in Module 3.1, Aggregate Demand.